you so much, everyone. My name is Semira Mohammed. I will be presenting jurisdictions try to define collective investment schemes through the functions or the economic functions that such arrangements try to achieve. This is done to prevent rigid definitions, which could be used as a regulatory arbitrage by the fund managers or the parties involved in the collective investment schemes. So most jurisdictions, such as the United States, the United Kingdom, as well as Kenyan laws, define collective investment schemes through the function, meaning the investors collectively pool money, and the management of this investment is done by another party, which is an entity, usually licensed, I think most of the time, licensed by the regulatory authority. And this separation of the investors and the control, meaning the management of the scheme, is mostly what we could see from these regulations. So one thing that I want you to grasp from this is that such definitions not only protect the investors as well, they also protect the business. So because the regulator is trying to set a perimeter where most arrangements which could fall in this type of activity could be regulated. So in Ethiopia, the Capital Market Proclamation defines a collective investment scheme in the same way as I have discussed, as they have been regulated by the many jurisdictions I have mentioned before. So the proclamation defines a collective investment scheme as an arrangement where funds are, I think it's working. So we could see three main features from the definitions of the Ethiopian Capital Market Proclamation. One is the economic function, where the pooled money is collected to invest in shares and other securities to share the profits and losses between the collectively between the investors. The other one is the separation between the ownership and the control aspect. So investors do not have a day-to-day management of the scheme, meaning this management is delegated to a licensed party, which is the CIS operator in this case. So this creates an inherent risk, which is an agency problem. The management is delegated to an investment company. This investment company, most of the time, does not have much capital investment in these schemes. So the investors who pooled their capital are delegating this management to a third party. So this creates an agency risk. So in this case, the CIS operator is the main body, meaning we could call this entity as the brain of the CIS, because all the execution as well as the operational aspect of the scheme's activities is delegated to this entity. The operator serves as the central brain, as I mentioned before. So this entity is required to be licensed by the authority. So this is a mechanism by the authority where such activities such as the fund management as well as CIS as an activity is regulated. So the main idea behind regulating this entity's activities is the controlling aspect that it has on the CIS. So as I have mentioned, this creates an agency problem. This is because the CIS operator has more information on the scheme's activities than the regular investors who only get periodic reports from the CIS operator. Another issue is an incentive misalignment. This is created where the interest or the intention of the CIS operator is not aligned with the investor's best interest. So this creates, in most cases, prohibited activities which are prohibited by the most regulators. This creates cherry picking. It could also result in related party transactions which are not approved or given authority by the investors. So this agency problem is the main issue in this paper, which I try to discuss. So most regulators try to minimize the risk that is caused by this agency problem. One, in most jurisdictions, such as the common law jurisdictions, the relationship between the CIS operator and the scheme investors and the CIS is considered to be a fiduciary relationship. So this relationship came from the equity tradition that common law systems have, but through time it evolved to prudent man rule, meaning the CIS operator is expected to us as if a prudent man in an investment could act. So currently, however, we are in the stage of prudent investor rule, where the court expects the CIS operator to act as an investor, a prudent investor, not only as a prudent man, but as a prudent investor. So the difference between the two is actually a result of economic behavioral analysis and the progress that we have from the 21st century and after that. So the prudent man rule was created after the efficient market analysis. So this considers the diversification as an important rule that the CIS operator should look into. In civil law legal systems, most jurisdictions do not have the fiduciary as a separate legal category. So, however, such the same function is employed where statutory laws, such as the laws of contract and obligation, require the interested person to act as a loyal server and through good faith and duty of care. In Ethiopia, the draft directive provides that the CIS operator should act with skill, care, and diligence, which more or less pertains to the civil law legal systems idea. So we have discussed the role of the CIS operator, which is, as I've mentioned before, the brain of the CIS. However, the regulatory system that we have, as well as the regulatory system in most jurisdictions, requires another oversight body that can oversee the activities of the CIS operator. This is more or less done by creating a trustee, another depository or a custodian that could allow the CIS to segregate the assets of the collective investment scheme from the CIS operator. So the custodian, as per the Principle 25 of the International Organization Securities Committee principle, the regulator must require the operator to use the custodian for the purpose of segregating the assets of the CIS from the operator. So in Ethiopia, we have this same requirement where Article 90 of the Capital Market Proclamation requires the CIS to have a custodian for the purpose of safekeeping and asset segregation. So the role of oversight in this case is for Ethiopia, this is the case for the directors of the scheme. So the law requires most corporately formed CISs, such as the private limited companies and share companies, to have an independent body, which is a board of directors. For those formed through partnerships, an independent body, which could have the same function as a board, is required as well. This is also an ISCO principle where the regulator is required to set standards for the schemes to have an independent oversight body, but the main difference is the principle does not strictly require a board. So this function can be done by a depository or sometimes through boards. So in the Ethiopian case, the draft directive requires the custodian, the board of directors, to review the related party transactions, changes in the investment policy, as well as the scheme has appropriate procedures to avoid conflict of interest and risk management. So in general, what the regulator does is, one, create a disclosure mechanism where the scheme's activities are disclosed to the general public. So this could allow the market to decide whether to invest in that scheme or to be involved with the management company that does this activity. So this is done by creating a disclosure system. So this could be achieved through a prospectus as well as periodic reports. The other one is deterrence. So this is where the regulator penalizes wrongdoers. The other one is creating a checklist of compliance, where a rigorous framework is created to achieve the same result, where the parties involved in the scheme do their job with the scheme current due diligence. So all of the regulatory frameworks that we have discussed so far have this principle, the principle that are set by the IOSCO on collective investment schemes. One is regulating the operator's conduct, the other is asset segregation, and we also have valuation and unit pricing. Valuation and unit pricing mostly work for the open-ended investment companies, but the others could be applied the same way. So the main issue on this paper is what could be the judicial assessment when CIS operators or the other parties involved in the scheme are found to be in violation of some of the procedures that are set by the CIS, the collective investment scheme. For example, the investment policy, which is the essential part of the scheme, which sets out the strategy, the policy, and the objective of the scheme. So in this case, most jurisdictions, including the EU system as well as the common law systems, provide a guideline for the judges to assess the procedural aspect of this investment decisions. So the judge will not be required to see the merits of the investment, meaning if investment results in loss, the process will be seen. So did the CIS operator have pass through the essential procedural aspects of getting the required approvals from the investors, the board, or did the establishment documents, such as the investment policy, allow this investment to occur? So in general, when such results happen, the judicial assessment will be expected to be on the procedural aspect, which could create a vague stance, but in most jurisdictions, this has been an issue throughout time, but I think, until now, the only result that the judges have achieved is to see the procedural violations.